This is a U.S. labor productivity measured as a 10-year annualized rate of change going back to 1950. And this is a short-term cycle indicator. This is the structural heartbeat of the American economy. And it shows it is not a miracle. It shows a long wave slowdown that has defined every major regime shift of the last 75 years. A long wave slowdown that has defined every major macro regime shift in the last 75 years. Let's slow and take a look at the chart correctly. On the x-axis, it's time from 1950 to roughly 2025, as you could see. And on the y is a percent growth in labor productivity expressed as a 10-year annualized rate. The 10-year smoothing is critical. It strips out recessions, recovery, stimulus bursts, policy noise. What remains is trend productivity, that kind that actually supports real wages, profit, and long-term growth. You see two lines. The blue line actually productivity growth, noisy but informative, and the red line, the smooth long wave trend. And that is important. That's important because it shows you exactly what is going on. And I think that it's important for you to understand what it is, because at the end of the day, what you want to take a look at, is the actual productivity of the chart. So let's take a look at the chart very much in detail. Let's see that wave, that all-important wave. The x-axis, 1950 to 2025. The y-axis, percent growth in labor productivity expressed as a 10-year annualized rate. And what remains is trend productivity. And you could see what is going on. What are you seeing? Well, it's a trend productivity. The blue line, actual productivity growth, noisy but informative, and the red line, the smooth long wave trend. Ignore the short-term wiggles, focus on the peaks, the trough, and the slopes of the red line. The red line is the story. From the 50s to the late 60s, productivity climbed steadily towards 3%. It's not financial engineering, it's just real economic muscle. Why? Well, post-war industrialization, massive infrastructure build-out, manufacturing scale, demographic moving with growth, energy abundance, genuine capital deepening. This area produced rising real wages, broad middle class expansion, low inequality, and manageable debt loads. Importantly, asset returns followed productivity, not the other way around. This is what real growth looks like. Don't forget to subscribe and thumbs up for this channel and support by being a member. We are looking out for you. Where is this going to end up? Then comes the 1970s through early 1880s. Productivity collapse, as you could see, from 3% down toward 1%. It's not a coincidence. This is a structural breakdown. Oil shock, desindustrialization, capital misallocation, inflation eroding real returns. Productivity unable to offset rising costs. This period culminates in stagflation. Can you say VOCA? It's volatility, a crisis of economic credibility. Markets struggle because productivity could not support earnings growth without inflation. Sounds familiar? Next comes the 1990s into the mid-2000s. Productivity rebounds sharply back towards 3%. This was the IT revolution, the personal computing, the internet. the enterprise software, supply chain globalization, China entry into the global manufacturing. But notice something crucial. This rebound, look at it, was narrower, shorter, less durable than the post-war boom. You see how close it is? Do you see not as extensive? It's a little bit tighter, shorter, less durable. And once it peaked in 2005, 2007, productivity rolled over again. From the 2010 onward, productivity grinds lower. What's going on there? Well, this is a critical takeaway. We created financial growth without productive growth. Capital flowed into share buybacks, asset speculation, real estate, financial engineering, not into productivity, enhancing investment at scale. This is why real wages stagnated, inequality widened, growth became fragile, and policy dependence exploded. Then, of course, the pandemic. You'll notice a small uptick post 2020. This is what many are betting on. This uptick reflects labor distortion, temporary efficient gains, measurement noise, work from home anomalies, not a sustained productivity regime shift. The red trend line remains well below historic peaks. This is not a new golden age. This is stabilization at a lower ceiling. So what does this matter for what we're doing now? Well, productivity sets the boundary condition for everything. Sustainable growth, corporate profit margins, real wage growth, debt affordability, interest rates equilibrium. If productivity remains structurally capped, growth disappoints, valuations compress, policy intervention increases, and volatility returns. Markets are currently priced for productivity renaissance. But this chart says, be careful. History shows productivity moves in decades-long waves, not narratives. Every major shift in the regime has been preceded by a productivity misunderstanding. Look at the chart itself, right? And you could see that the last time around, it went from 1990, right, to 2005. So it took 15 years. But it was shorter, squeezer. So every market regime shift has been preceded by productivity misunderstanding. This chart is not bearish, it is discipline. It's if productivity truly accelerates, markets can grow into valuation. If it does not, something else must adjust. And historically, that adjustment is rarely gentle. Again, this chart really exemplifies the fact that we are priced for perfection. And these cycles are getting shorter. We're not saying crash, we're saying be very careful.